In the world of investing, people often get confused between terms like index funds, mutual funds, ETFs, and hedge funds. They all sound like fancy financial products, but the truth is they serve very different purposes. Imagine 4 different vehicles, each designed for a specific type of investor, speed, and risk level. Index funds are like a steady train. They follow a track, which in this case is a stock market index like the S&P 500. They do not try to beat the market. They simply match its performance. Because they are passively managed, fees are low and performance is predictable. They are ideal for long-term investors who want stability without constant monitoring. Mutual funds are a bit more active. A professional manager picks the stocks or bonds they believe will do well. This can lead to higher returns, but it also means higher fees and the risk of underperforming if the manager makes bad choices. They are better for investors who want a hands-off approach but believe in expert management. ETFs, or exchange-traded funds, are like index funds that trade like stocks. You can buy and sell them throughout the day, just like individual shares. They usually have low fees, can track indexes or specific themes, and are flexible for both short-term and long-term strategies. Hedge funds are a different beast altogether. They are exclusive investment pools for wealthy individuals or institutions. Managers use aggressive strategies, leverage, and high-risk investments in the hope of big returns. They also charge high fees, often 2% management and 20% of profits. When deciding between these 4, you have to think about your goals, your risk tolerance, and your timeline. If you want low-cost, long-term growth without much involvement, index funds make a lot of sense. If you trust a professional to try to beat the market and you do not mind paying higher fees, mutual funds can work. If you want flexibility and the ability to trade at any time of day, ETFs are a good choice. If you have a high net worth and want aggressive, high-risk strategies with potential for big rewards, hedge funds might be for you. The key difference also lies in accessibility. Anyone can invest in index funds, mutual funds, or ETFs with relatively small amounts of money. Hedge funds often require millions just to get started. In terms of liquidity, ETFs win because you can trade them instantly during market hours. Mutual funds and index funds usually settle at the end of the day. Hedge funds can lock your money for months or years. For costs, index funds and ETFs generally have the lowest expense ratios, mutual funds higher, and hedge funds the highest. For risk, index funds and ETFs tracking large indexes are typically low to moderate. Mutual funds can vary based on the manager's strategy. Hedge funds are high risk. The smartest investors match the product to their lifestyle, their risk appetite, and their long-term plans. And if you are new to investing, starting with a low-cost index fund or ETF can be the safest way to build wealth over time while you learn. If you want a beginner-friendly visual guide comparing all 4 with examples, fees, and risks, download our simple one-page investing cheat sheet from the link in the description. Now let's compare their accessibility. Index funds and ETFs are usually open to anyone with a brokerage account. You can start with small amounts, and they have no special investor requirements. Mutual funds are also easy to buy, but they may have minimum investment amounts. Some require you to invest a few hundred or even a few $1,000s to start. Hedge funds, however, are highly exclusive. They are typically available only to accredited investors, meaning people with very high income or net worth. On the cost side, index funds and ETFs win in most cases. Because they follow a passive strategy, their expense ratios are much lower. Mutual funds, especially actively managed ones, have higher fees. Hedge funds have the highest costs of all. They often charge the infamous 2 and 20 model. That means 2% of assets under management each year plus 20% of any profits. In terms of liquidity, ETFs are the most flexible. You can buy and sell them at market prices throughout the trading day. Mutual funds and index funds only trade once per day after the market closes. Hedge funds often lock up your money for months or even years, which makes them unsuitable for short-term needs. Risk levels vary as well. Index funds and ETFs are relatively low risk if diversified across the whole market. Mutual funds vary depending on what they invest in. Hedge funds may take on high levels of risk using leverage, derivatives, or concentrated bets. Finally, performance expectations. Historically, most active mutual funds and hedge funds fail to beat the market over the long term after accounting for fees. Index funds and ETFs aim to match the market, which has been a winning strategy for many long-term investors. If you want a simple, beginner-friendly way to invest with low fees, consider starting with index funds or ETFs. If this breakdown opened your eyes, remember that smart investing is not about chasing the hottest tip. It is about building a system that grows over time. Start simple, be consistent, and let compounding do the heavy lifting. To make your journey easier, we have created a beginner-friendly digital guide that walks you step by step through setting up your first investment portfolio. It includes checklists, templates, and plain language explanations so you never feel lost. Download it today and take the first real step toward your financial freedom. Thank you, happy investing.